let me now bring on board Sandeep Jesha, Chief Executive Officer with Sampriti Capital. Sandeep, even though rupee has plunged to a new all-time low against the dollar and there's virtual gloom and doom when it comes to Indian markets, you're of the view that the Nifty and the rupee, they both could be nearing the end of the decline. Why is that?
Well, to begin with, I think it's important to put in perspective that we had given a sell call around 5,400 Nifty, not once, but about 3 times, every time it touched there. And because we felt that there was a lot of unfinished agenda, there were too much of expectations, and we knew that execution is always a problem. And what I was also worried about is that global cues would deteriorate, and I'd mentioned that we could get to 46 to 4,800 if global cues also deteriorate, and that's exactly what's happening. But I think if you want to look at what's happening, sure, there's a lot of problem in Europe. It's not just a problem of Greece, it's a problem of contagion, it's a problem of growth, it's a problem of growth in US, it's a problem of growth in China, but that's possibly the only one that's a global factor that's stacked in our favor, is that if China continues to slow and commodities continue to correct. The problem is, of course, that the rupee continues to fall. Now, the rupee is obviously the single most important indicator of confidence in an economy. But, I think you've got to look at the rupee over a longer term perspective. I think the point is that pessimism is so high, there are bears everywhere. Even if you look at the fact that the rupee hit a new low yesterday, the market did not make a low. The market was actually higher than it was a few days back. So I think that tells you something. And the other most important thing is that as the rupee falls, local investors sell thinking that foreigners will sell. But, I think most of the hot money's already exited the system. Most of the foreign investors that are left are pretty much longer-term investors. And at these levels, stocks are really cheap in dollar terms for them to actually sell. And that's possibly one of the reasons why we haven't seen the selling. And it's quite likely that if all we need is some trigger. Now, I don't know what that's going to be. That's more difficult to predict. We've not even had a petrol price hike. But I think it's fair to assume that some petrol price hike will happen. And, maybe some of the RBI measures will start taking fruit. See, the rupee is already significantly undervalued at this stage. I mean, if you were to look at the rupee on a purchasing power parity basis, I think that there would be some amount of upside here. So it's only natural that markets tend to overreact. They tend to go from excessive greed to excessive fear or pessimism, and all that we are saying. But I think the rider here that I want to put in here is that we are looking to buy here between 46 to 4,800, but we are still not looking to buy the infrastructure and the capital goods and the property names because there are still fairly serious issues out there. So, we are happy to buy some of the consumption names which have corrected significantly. We are happy to nibble at, some of the private sector banks and the auto. So that should tell you that even though one is looking at this with cautious optimism, it's not an outright, a call saying that just go aggressively and buy whatever you can because market's going to be much higher from here. I don't think it's that kind of call.
Sandeep, it's interesting that you've mentioned your bias towards autos, considering a currency fluctuation is not going to augur well for the auto space. We've seen dwindling sales volumes and concerns, of course, with names like a Tata Motors and the stock selling that we've seen there. What pockets catch your interest amongst the autos?
Yeah, well, Tata Motors is actually a global play. It's not an India play at all. So there, you've got to take a call on global growth. See, Tata Motors has been doing well in spite of a faltering global economy. Now, I don't know how much longer that's going to continue for. Maybe it might continue much longer. But that's not what I'm talking about. We have not yet bought those, but I think that if the two-wheelers were to correct from here, at some point of time, the fact that we are seeing 6 to 8% volume growth will get priced in. Perhaps if Maruti were to correct significantly from here, that could be interesting. I don't think that at today's prices we are looking to buy auto stocks. And obviously, even if you want to buy auto, you want to wait for that, whether you're going to see a petrol price hike, and if you see that, then you want to wait for that before you get in. Also, at some point of time, I think the rupee will stabilize. I don't know where that level is, whether it's 56 or worst case 58. But this kind of sharp fall cannot continue forever. I mean, it's got to stall sometime. And I think I would again like to highlight what I just said a couple of minutes back. Even as the rupee has made a new low, the markets have not. And I think that should tell you something.
Is it right to compare that?
Well, I hear people talking more about the rupee than I hear people talk about anything else. The words I hear most often, people who didn't know what current account deficit are discussing the current account deficit and the rupee and the fiscal deficit as if that nothing else matters, and there is no other economic parameter of any significance. I agree there isn't a 1:1 correlation, but you saw yesterday what happened. Just as the rupee made a new low, the market immediately corrected. So it's not that there isn't, even if there isn't a 99% correlation, currently the markets are moving, that there seems to be some sort of a loose negative correlation. So I think it's just, if you were to ask people, what are your biggest concerns? And, the number one concern people will put up is the rupee. At this stage, I'm talking about people in the market. I'm not talking about corporates. They would give you the other concerns. So given that, I think it's just useful to understand that, to just put things in perspective. I'm not saying that just because of that's the reason. There's much more to it, right? Because you have seen some sort of correction. I've been saying that the great Indian consumer bull market, which began in 2003, 2004, continues and will continue for the next 3 to 4 years. You don't need government intervention there. It's doing well in spite of the the adverse economic environment that we are in, and I don't see any reason to believe that that's going to change. So, and you also know that the point of the other thing I would like to highlight is that though sentiment is bad, it's probably not as bad as it was when the Nifty was 4,500, and we are still higher than 4,500. So, it's really a sentiment call. It's really a call that, from here things I can't think of too many things which could incrementally go wrong from here. I can think of a lot of things which could improve from here, but I can't think of too many things which could go wrong from here incrementally.
Right. Just to, make a point on consumption, do you think it is right to be bullish on consumption at a time when food inflation is high, interest rates or high interest rates are eating into savings, and then salary levels pretty much in the last 2 or 3 years have been stagnant?
Well, so you've got to, I think one is not looking at the interest rate sensitive so aggressively to begin with, or the high value purchases. But if you were to look at, and you've got to be selective, right? So even though there's a broad brush that doesn't mean that, we buy the top 3-5 stocks in the sector. That's not the way you do it. You look for pockets of value, relative value. You look for stocks where the earnings growth seems significantly robust, where there is some degree of there is either a margin of safety or stocks are just fairly valued but not overvalued. So you've got to be careful, and you've got to buy stocks. It's got to be a bottom-up stock picking once you've identified that. But there are stocks which have corrected. And the other thing is that if you look at the mid-cap consumption space, there are a lot of relatively cheaper stocks. And this is a longer-term call, right? At the bottom of the market, you will always find reasons you will find all the reasons what are going wrong. You'll never find a single reason about what's going right. Similarly, at 5,400, nobody could think that we could go down here, and I was the only one who said that you could even see a sell-off below 5,000. So this is the nature of the beast, It's inevitable that at the bottom, everybody will give you reasons why markets can't go up, and at the top, everybody will give you reasons why markets can't fall.
A very simple correlation is that decline in rupee will benefit large cap IT stocks. But even the rupee, it's been a one-way street for rupee, large cap IT stocks have been underperformers.
Well, I think you've got to look at the fact that they had a serious bout of outperformance initially as the rupee started weakening. And as the global economy, signs of the global economy faltering have picked up, and right from, it was initially just Infosys, but then even Cognizant actually came and pared their guidance. So I think people are realizing that even as the rupee weakens, there is a risk of demand faltering. And remember that a lot of the buyers out there or their customers are very sharp, very smart corporates, some of the biggest companies in the world. They also understand that these companies' costs are in rupees. So they're obviously perhaps also going to try and tighten the screws a little bit and ask for more price discounts. So it's never a simple game, right? And the other thing is that not all companies are, some of the companies are hedged and they don't benefit and some of them don't. So there's also an individual case. So I think the reason, of course, is that is the fact that we've had we've had Cognizant lowering their guidance, and also signs that Europe is slowly but surely falling into recession. And if you look at US GDP growth sequentially from 3% to 2%, I think that's the other thing. Just a quick aside actually here. I want to point out that, when I'm talking about 46 to 4,800, this doesn't include a complete euro quake. And my base case assumption is that the government will continue to act even if ever so slowly. Some people would argue that the government is not moving. I would argue that they're moving, but perhaps so slowly that it seems to be too slow. So I just wanted to add that.
At the time, you expect that, or you are of the view that the risk-reward ratio currently is in favor of going long. Where are you putting your money to work?
Well, we just discussed, some of the sectors that we would be looking at. And what I also said that is that 46 to 4,800. So we are just shy of that. So we did dip into that level. So it's the same thing that I mentioned. It's going to be pharma. It's going to be FMCG. It's going to be, if we see a significant correction, then perhaps some auto stocks and a few of the mid-cap mid-cap private sector banks, the new generation ones. So it's really going to be that. So the outlook remains quasi-defensive in the sense that you want to build up the beta in your portfolio and you want to build up the risk in your portfolio only as you get conviction that things are improving, whether it's inflation, whether it's interest rates, whether it's government policy. As we see movement on that, that's when you start building risk in your portfolio. That's when you start adding the beta in your portfolio. But if your model portfolios are sitting on 40 to 60% cash, I mean, that's a lot of cash. And that's some amount of cash that you want to deploy.